This is Satya Pradyuman in Cirrus Research. The latest active voice report, this tends to be a more detailed study of a given subject, takes a look at the Fed liquidity and its impact on equities. The title, Liquidity Matters, Fed Action and Equity Sensitivity. I think this is a big deal. Clearly, we've all become Fed watchers in 2022, and I suspect some of us will remain Fed watchers in 2023. If you look at this two-panel chart here, this sort of walks through what we've just modeled. The lower panel reflects what we would really sum up as a liquidity model. Effectively, we've taken critical variables. The major ones would be clearly M2, the Fed balance sheet, and a few other measures to bring into concert. And what we've done is created a collapsed diffusion signal into a liquidity model. This goes back the last 20 years or so, and correctly so. As you look at the '08 event, we saw a ton of liquidity being added. Subsequently, what was removed? We saw the pandemic event, massive amounts of liquidity being added, and now we're going through the reversal. At the heart of it, to no surprise, the idea is that as liquidity gets easier, markets tend to do better, and vice versa. The big question is, where are we at now that we're about 6 or 12 months, depending on how you're measuring this, the sort of Fed signaling has begun. And what this indicator allows us to do is it basically is able to bring us to the expected return 1, 3, 6, and 12 months into a tightening cycle. And it's super important to recognize that even 6 months in, the expected return in a tightening window, the purple bars, are still negative. And so the reality is that we've gone through a lot. The market's done a great job pricing in concerns. Speculation's really been beaten down. That said, we're still in a regime in which the Fed will continue to tighten. And so this puts a pause on this sort of bullish sort of fervor that may be surfacing a year after a very, very tough market. To put this together, we put together this diagram to sort of represent some of the data that's instructive. And basically this sine curve represents periods of where liquidity grows, periods of where liquidity is tightened. And if we were to model this data based on the regime flow that we've come up with, what you'll see is that 2022 was a year in which liquidity really fell off. If we were to model this correctly based on the forward returns on equities, this reading would tell us we're somewhere about here, not at the end of the story or the beginning of a bull market. So again, this I think is a sobering reminder that as the Fed is making its moves, we've got to really be cognizant of where they're at in this chapter. Our bottom line here, though, is that we are clearly much more constructive on equities, but this overarching concern with liquidity will be an overhang for at least the first half of 23. Take a look at it. Plenty of detailed numbers and instructions on how we pull together this framework. And as always, we'd love your feedback. Thank you.